Chapter 4 covers financial services and savings and payment plans. Here are the learning objectives for Chapter 4. I know you can read them, but I will too, to be clear about what we want as takeaways from this chapter. Learning Objective 1. Identify commonly used financial services. Number 2. Compare types of financial institutions. Number 3. Assess various types of savings plans. And 4. Evaluate different types of payment methods. Ways of saving, and particularly of paying, have changed significantly over the last decade. Deposit checks from an app on your phone. Use mobile payment systems to pay a person via Venmo or a company via PayPal or the company's website or your bank's online payment system. We write very few checks these days. We just don't need to anymore. Various financial services are used to meet daily and long-term financial needs. Managing your money means watching what you do on a daily basis. Common mistakes include, of course, overspending. Just about everyone does it at some time. It's easy to $10 yourself into trouble. Insufficient liquid assets. Not having enough cash available in an emergency. Paying current expenses out of savings or borrowing to cover those expenses. Failing to earn interest on unneeded liquid assets. Remember your goal, increase net worth, which means save more, owe less. Exhibit 4.1 on page 108 in your text gives a graphic representation of the types of financial institutions and services available. Starting at the top, the ones we're probably most familiar with: deposit institutions, commercial banks, and credit unions. Non-deposit institutions also offer a variety of financial services. These include credit card companies, life insurance companies, investment companies, and finance companies. Other financial services providers include pawn shops, check cashing outlets, payday loans, and rent-to-own centers. Finally, no-bank financial service providers include retail stores, online banking, and payment services such as PayPal, and peer-to-peer lending. We'll look at each of these types of institutions in more depth on the following slides. So where can you get quick cash when you need it? You could take it out of your savings or cash in a CD or mutual fund shares. You could borrow the money. The problem, either option reduces your net worth. So what types of financial services are available? For savings, you've got time deposits, savings and CDs, payment services, checking accounts, or demand deposits. Set up automatic payments through your bank. Short or long-term borrowing, and other kind of specialty services, insurance, investments, real estate, tax assistance, trusts, financial planning. An asset management account is a very popular type of investment account. It's also known as a cash management account. It typically includes a checking account, an ATM card, a credit card, online banking, a line of credit, and investment access. In the Memphis area, these are offered by Duncan Williams Asset Management, Southeastern Asset Management, Longley Partners, and Regions Bank. Online banking offered by virtually all large commercial banks and many credit unions. Does anyone get a paper paycheck anymore? Direct deposit is so much more convenient for you and for your employer, and the money's in your account immediately on payday. You can set up automatic payments and reminders for recurring bills like gas and water, a car note, or a home mortgage payment. You can set up an automatic savings plan that transfers a set amount to a savings account every week or every month. Almost as good as having it taken out of your paycheck before you get it. It's a painless way to begin saving. E-banks and e-branches are a bit newer. For example, E-Trade Bank operates online and provides ATM access. Everyone needs cash from an ATM periodically. Using your own bank's ATM is usually free. Using other ATMs can carry a fee. Debit cards can help overspenders get control. No money in your account? You can't buy anything, period. The downside to a debit card is it builds no credit record. The next step from online banking, and not much of a leap, mobile banking. Most large banks have mobile apps available. My bank, Regions, offers online deposit, which is free for normal access, but charges a fee for faster funds availability. As with online banking, only more so, there are issues of privacy and security. This slide just recaps the services available online and via mobile banking. Under Payments and Transfers, the newest option is the next to last one, using your phone to make a purchase: Apple Pay, Samsung Pay, Android Pay. Note that research has found that using your phone to pay is faster than a chipped card and more secure. Deposits online are still somewhat new and may incur a fee, but most other services are free and readily available. Basically, with your bank's app, you can control your entire banking needs via your phone. So the pros and cons of online banking. The major pros are convenience. Your online bank is available 24/7. It provides a full record of all your transactions and will remind you when payments are due. The con, as with anything online, privacy and security are always issues. The other main con is the difficulty making cash deposits. Most bank apps have taken care of depositing checks. Cash, you still have to go to the bank. Prepaid debit cards are offered by a variety of financial institutions and even retailers such as Walmart. The major advantage is that it's a pay now, buy later, resulting in lower consumer debt versus credit cards, which is the buy now, pay later model. But be aware of the fees attached. They can be significant. Interest rates, the cost of money. If you're borrowing, low is good. If you're saving, high is good. Either way, you need to be aware of what current rates are and what's expected. As of July the 10th, 2018, the prime lending rate, the benchmark was 5%. Watching current rates and expected directions helps you make smart financial decisions. If you're expecting rates to go up, long-term borrowing, lock in the low rates. Short-term saving, wait for the higher rates. If rates are expected to fall, do the opposite. Short-term borrowing, wait for the rates to fall. Long-term savings, lock in that higher rate now. Common sense, but you have to watch current rates and pay attention to what the Federal Reserve is doing and saying to be aware of the expected direction of rates. I'm recording these lectures in the summer of 2018. So as of July the 10th, 2018, national averages, 30-year fixed mortgage, 4.39%. 15-year fixed, 3.82. 5-year CD, 1.74. 2-year CD, 0.9. 1-year CD, 1.06. 60 months new car, 3.98. 48 months new car, 3.82. 36-month used car, 4.26. The options for where to obtain financial services has expanded well beyond traditional commercial banks. Comparing financial institutions is a personal decision. It depends on which services you need, which you'll use the most, and what's important to you. Higher return on your savings, minimum cost for services, availability of loans. The first step in any financial decision is determining what your needs are. What's important to you? Which services do you need? Savings, checking, loans, mobile app? What do you care about the fees? Minimum balance requirements, ATM fees? Convenience, assuming you have to actually go to the bank, is there a branch convenient to your home or office? How easy is it to bank online? Step 2, you rank these and then start looking for institutions that meet your needs. Once you have a clear picture of what you're looking for in a financial institution, check out the available options. Don't neglect smaller local banks. They can offer very attractive rates and hometown services. And ask friends whose opinions you trust where they bank and are they happy with their bank. A personal visit to a branch can give you a good feel for how you'll be treated as a customer. Step 5, choose the best fit for you. You can use more than one institution to obtain the best services for you, but balance the rates and services versus the convenience of using just one. Having a main bank where you have all of your accounts can have benefits if you need personal help. Say having a fee reversed that you think was unfairly charged. The bank may agree to do it to keep you as a customer. Finally, if you do decide to change banks, there are switch kits available to make it easier, especially changing direct deposits and automatic payments. So, in looking for a financial institution, what types are out there? Deposit institutions, as the name implies, they take deposits. Commercial banks are the most common. They're organized as corporations. They typically offer a full range of services, including deposits, loans, and investments. These are the main banks that have been around forever. Regions, First Tennessee. Savings and loans, not that many are left after the S&L crisis in the 1980s. Generally operated like commercial banks with a primary focus on home mortgage loans. Mutual savings banks, not many of these around either. Northwestern Mutual has a mutual bank subsidiary. The key point is the bank is owned by the depositors. Credit unions are user-owned. They're non-profit. They offer lower fees and rates. They're typically associated with a business or an organization. The Teachers Association, Navy Memphis, Federal Express. If you're eligible to join one, do so. Their rates are usually lower than available anywhere else. The term financial institutions also includes non-depository firms, life insurance companies. Some also offer savings and investment programs as well as financial planning services. And investment companies. These offer mutual funds, money market funds, but they're not covered by the FDIC. Brokerage firms are also act as non-depository institutions. Credit card companies do offer short-term loans, finance companies, high-rate, short and medium-term loans, and mortgage companies, home mortgages. A few financial options are, to say the least, problematic. Pawn shops. They are a source of quick cash for possessions, but they charge high fees. Check cashing outlets, also known as currency exchanges, they charge a fee on the face value. More problematic, desperation level options. Payday loan companies, cash and check advances, very high interest rates. Rent-to-own centers, very high interest rates. Car title loans, do I need to explain this one? Very high rates. The maximum loan in Tennessee and Mississippi is $2,500. Let's move to savings. Regular so-called passbook savings is the most common. Virtually no minimum balance, but a very low rate of return. Easy withdrawal, they're insured. Most of us probably started with a savings account as children. A savings account at a credit union is termed a share account, since you're basically a shareholder in the credit union. CDs are typically time deposits in the sense that there is a time on it and a penalty for early withdrawal. There is also usually a minimum deposit. The funds must be left for the entire period or incur a penalty for withdrawal. A wide variety of types to fit all needs, offered with usually higher rates for longer terms. You can see the list of CD names on the slide. We won't go over each type in our short class, but it's obvious that if you want to consider a CD, there's probably one that fits your needs. Be sure to understand the rates and fees involved with buying a CD. Do not allow your bank to automatically roll your CD over without doing your due diligence on current rates and fees. Consider creating a portfolio of CDs with more or less laddered maturity dates. Many banks also offer interest-earning checking accounts, though these typically require a minimum balance at all times. U.S. savings bonds, frequently bought as gifts for children. These are the original zero-coupon bonds. They're sold at half of face value, very low minimum, they pay a fixed rate, and they earn interest for up to 30 years. I-bonds are indexed, paying a fixed rate plus an inflation premium adjusted twice a year. Individuals can purchase Treasury securities online via Treasury Direct. Money market accounts and funds sound the same, but they aren't. Both have floating interest rates and allow some check writing, but accounts are insured by the FDIC, funds are not. This is Exhibit 4.5 on page 116 in your text. This graphic recaps the pros and cons of the saving alternatives we've covered. Regular savings accounts offer low minimum balance, ease of withdrawal, and they're insured, but low rates of return. CDs offer a guaranteed rate of return and are insured, but there'll be a minimum deposit and a penalty for early withdrawal. Money market accounts and funds offer favorable rates and frequently allow a minimum number of checks to be written, but they require a higher minimum balance than regular savings accounts and charge a fee if the balance drops too low, and the funds are not insured. And finally, U.S. savings bonds, I-bonds. The rate varies with inflation. They require a low minimum deposit, they're government guaranteed and exempt from state and local taxes, but the rate of return is lower if redeemed within the first 5 years. Here are the 6 criteria for selecting a savings vehicle: rate of return, inflation, taxes, liquidity, how fast can you raise cash, safety, restrictions and fees. We're going to look at each of these briefly on the following slides. For a savings plan, rate of return can be critical. Rate of return, or yield, means the percentage increase due to interest earned on interest, compounded. As we looked at in reviewing time value of money, more frequent compounding increases the future value. Annual yield for 4% annual is 4.08 if compounded daily. As should be obvious, higher interest rate, higher future value. Longer time on deposit, higher future value. The Truth in Savings Act requires that both lenders and depository institutions disclose the interest rate paid or charged in a specific format. APY is annual percentage yield, APR is annual percentage rate. In either case, the rate is the periodic rate times the number of periods per year. So if a lender charges 5% per month, the APR is 5% times 12, or 60%, and that's the rate they must quote you. What to consider when looking at savings plans: inflation. Inflation reduces the value of interest earned. In evaluating returns, compare them to the rate of inflation, current and expected. Taxes. Like inflation, taxes reduce earned interest. The higher your tax bracket, the higher the hit. Liquidity. Liquidity has two dimensions, equally important: the ability to convert an asset to cash quickly without significant loss of value. We can sell anything quickly if the price is low enough, so the second dimension is critical. With safety, the FDIC insures up to $250,000 per person per institution. The NCUA, the National Credit Union Administration, covers credit union accounts. And of course, restrictions and fees. Minimum balance requirements are by far the most common. Some accounts charge by transaction or by check written. Paper checks are quickly becoming an antique. It is so much easier to pay your bills online, yet most of us still have a checking account, as there are times when you just need to write a check. This chart compares three general payment methods: digital, debit and credit cards, online payments, prepaid store cards, smart cards, and peer-to-peer. Checking account, handwritten checks. Other forms: cashier's and certified checks, money orders, and traveler's checks. But you don't even see these much anymore, as travelers simply use their credit cards. We're going to look briefly at each method. Debit card transactions. We've already talked about these. Immediate deduction from your linked account, but it builds no credit history. Online payments. PayPal definitely changed online buying by offering a safe way to transact with people and companies without knowing them. What started with eBay has expanded so that many online retailers accept PayPal. Even some academic journals accept PayPal for renewals. A variety of other online payment and peer-to-peer services have been developed, but be careful about linking these to your credit card, or even more seriously, to your bank account. Mobile transfers offer apps to support mobile payments, and they're popping up every day. These are expected to replace both credit and debit cards. Stored value cards are basically prepaid cards. Telephone and tolls are common, and gift cards fall in this category. We're moving in the direction of chipped smart cards. The talk now is that these will expand to fingerprint ID cards. Peer-to-peer payments allows the direct transfer of funds from your bank account or credit card to another person. PayPal, Google Wallet, Venmo. Be careful. With your credit card, you're protected somewhat against fraudulent access, not so much with your linked bank account. The credit card versus debit card debate. A credit card makes sense if you want to delay payment, you need to build a credit history, you're buying online, for major purchases, to earn rewards, and you need one to rent a car or to book a hotel room. A debit card makes sense if you want to control your spending, avoid future bills, and avoid interest or fees. Regular checking accounts for years were the standard way to pay monthly bills. Write a check and mail it. A minimum balance is usually required to avoid monthly charges. Still, having the ability to write a check is still sometimes required unless you choose to deal 100% in cash or credit. Activity accounts are low-activity checking accounts with a fee charged for each check written. If you just need a basic account and you don't want to maintain a minimum balance and you write few checks, this could work for you. Banks and credit unions offer interest-bearing checking accounts, but these typically require a minimum balance. From the text, page 125, this is a chart recapping the decision criteria for selecting a checking account. This slide and the next. Pay particular attention to the minimum balance requirements. Be sure the account is insured. Monthly fees and specialty fees. Continuing Exhibit 49, availability of ATMs. The availability of online banking and any fees involved. Interest rates paid and charged. Any minimum deposit requirements and penalties for dropping too low. Any special group deals, students, senior citizens, veterans. Doesn't hurt to ask. Continuing our look at checking and payment methods from the preceding chart. Beware of package deals. They may charge you for services you neither need nor want, but you're going to be paying for them. There are other payment methods, though infrequently used. A certified check and a cashier's check, both guaranteed payment for a fee. Note that the cashier's check can be canceled, but certified checks are harder to stop payment. Money orders can be purchased at post offices and in many stores. Traveler's checks used to require double signing, once when they were issued and again when they were used. Not used much now since credit cards are widely accepted all over the world, and traveler's checks are actually issued in credit card form usable at ATMs. Assuming you decide you do need a checking account. Opening the account. Individual, your name only. Joint, be careful of and. Use or. The or can be a spouse, a parent. Endorsing checks. A blank endorsement is just your signature. Once it's signed, it's negotiable by anyone. Restrictive, for deposit only with an account number. Or special, pay to the order of. It transfers the check to a third party. These are not widely accepted. Writing checks. You need to record the date, who you wrote it to, the amount in figures, the amount in words, sign it, and note the purpose of it. Reconciling your bank account, you need to compare your record of checks written against the list of checks cleared on your bank statement. Subtract checks written but not yet cleared. Add deposits not yet shown on your statement. Subtract fees or charges and ATM withdrawals. Add any interest to your checkbook total. This should balance your checking account. If it doesn't, go back and recheck everything. If you can't find the discrepancy, contact your bank. They can make mistakes. They will help you find it. You definitely should reconcile your checking account every month. This is a window into your spending habits. You need to be sure all deposits have been posted. You should definitely check any ATM withdrawals to be sure they're you. You want to be aware of any fees your bank is charging you. If you find an error, do not hesitate to ask your bank to resolve it. It's your money. We'll walk through a bank reconciliation example. The online balance shows $1,250. Your spreadsheet balance shows $450. Outstanding checks on the worksheet not cleared, $795.50. Online interest, 50 cents. Online reward credits, $4. Does this balance? Online balance minus uncleared checks, $1,250 minus the $795.50 is $450. Add the interest and rewards to the spreadsheet, $450 plus 50 cents plus 4, $450. The account is in balance. Summarizing this chapter, these slides go over the 4 learning objectives. Learning objective 1 was identify common used financial services. We covered all the basic ones: savings plans, checking accounts, loans, electronic banking. We'll cover trusts in chapter 14. Learning objective 2 was to compare the types of financial institutions. We covered a wide variety of types of financial institutions and the criteria to compare them. Learning objective 3, this recaps types of savings plans and criteria for evaluation. And learning objective 4, evaluate different types of payment methods. As with savings plans, we covered basic payment methods, the most common being debit and credit cards and regular checking accounts. This concludes chapter 4. The remaining slides are designed for auto readers.